Hey, happy Friday and happy early 4th of July weekend to you. 2-1 buy downs, temporary buy downs. So I wanted to show you now that the entire conversation has moved away from covering appraisal gaps to how do we get buyers into a house? How do we make a house that's been sitting on the market more appealing? And so the way we do that is instead of buying down, instead of getting a price reduction, instead of that, using a seller concession to do either a temporary or a permanent buy down. So I'm going to show you some examples here. Okay, so if we take this hypothetical home at 550, a buyer with 5% down payment today is going to get about a 5.875 rate, and they're going to have a $3,500 payment. If the seller is trying to make the home more attractive, the traditional route is to do a buy down, or I'm sorry, a price reduction. So that would be this fourth column here. So if you do a $12,000 price reduction, as an example here, dropping the price from 550 to 538, the payment drops, of course, because they're borrowing less, but it's only about $70 lower. So it's really not that exciting to a buyer. There's better ways. There's two much better strategies to do this. One, the second column here, we've done 5 times just this week, and I sent out a similar video like this last Friday to our pre-approved buyers, 2 people that were on the fence and really had put things on hold because they were burned out from the spring. Got back in, made offers, got about a $10,000-$15,000 seller concession instead of offering a lowball price, offering the list price, getting that concession. And by doing that, in this case, in this hypothetical example, instead of 5.875, if the lender has an extra $12,000 to work with, they can buy down the rate 0.75%, which drops the payment almost $250 per month. So we saw several of those this week. That's called a permanent buy down. So you're taking extra fees, points that the buyer is paying, but they're paying them with the seller credit. So the amount due at closing remains the same, but they end up with a significantly lower payment. Another option is what's called the temporary buy down. So that's this column here. A temporary buy down takes an interest rate, whatever the interest rate is today, and there's 2 different types. There's what's called a 1-0 buy down or a 2-1 buy down, and I'm doing an example here of a 2-1 buy down. A 2-1 buy down essentially is a 30-year fixed at 5.875, but for the first 12 months, the buyer pays 2% below that, or 3.875. For the second 12 months, second year, they pay 1% below that, or 4.875. And then years 3 through 30, we have the normal 30-year fixed at 5.875. That 2% reduction drops the payment about over $600 a month. That's like buying a $550,000 house with the payment of a $450,000 house. That is a way to definitely make a house more attractive if it's marketed correctly. The money to do that, that the $600 that the buyer's not paying the first 12 months, and let's call it $300 that they're not paying the second 12 months, that's about $12,000. And so we can do that by, again, getting a $12,000 seller concession and structuring the loans so that the buyer is, easing into that home payment at this rate for the first 12 months, 1% higher for the second 12 months, and then years 3 through 30 at 5.875, with the understanding that we are thinking there will be a recession in the next few years, if not sooner. And at that point, we can do a refinance for them, and hopefully they can get a 30-year fixed, somewhere between this level, and that will be the long-term loan. If you have any listings that you want to discuss this strategy for, or if you have any buyers that you think this would be a good fit for, let's connect. I'd love to help, and let me know if you need any help this weekend. We'll talk to you soon. Bye-bye.